Hey everybody, welcome to another episode of Foreclosure Help 777, where we talk about everything foreclosure related. Thank you for subscribing to my channel, and I hope you are learning from these videos. And if you have any suggestions for future videos, you can leave them in the comment section or send me an email. My email address is foreclosurehelp777@gmail.com. So if you have any questions about your own foreclosure and you need assistance, you can always reach out to me and I will help you as much as I possibly can. Okay, so today's topic is called the mortgage loan life cycle, from closing table to courtroom. Okay, it's very informative. Now our Bible verse of the day is Ecclesiastes 3:1. To everything there is a season and a time to every purpose under heaven. A time to be born, a time to plant, a time to reap, a plan to heal, a plan to weep, a time to launch, a time to mourn, a time to dance. That's our verse of the day. So, in foreclosure context, just as everything has a beginning and an end, every mortgage loan follows a life cycle. Understanding each stage helps homeowners identify where mistakes, violations, or missing documentation may have occurred. When most people buy a home, they believe that their mortgage stays with the company that made the loan. In reality, today's mortgage often changes hands multiple times over its life. It may be sold, securitized, transferred to new servicers, or even become part of a mortgage-backed trust. Understanding this journey is essential because every transfer should leave a paper trail. Missing documents, conflicting records, or unexplained gaps can become important issues in foreclosure litigation. Today we'll follow a mortgage loan from the day it is signed and in some cases the courtroom steps. So stage 1 is your loan origination, when the documents were created, your promissory note, your mortgage or deed of trust, your closing disclosure, your loan application, truth in lending disclosures, the actual security instrument. Borrowers sign the note, lender funds the loan, the mortgage is recorded, the lender now owns the loan. Stage 2, the loan is sold. Many loans are sold within weeks or months. Possible buyers include another lender, an investor, or a mortgage aggregator. The company collecting your payment may no longer own your loan. Stage 3 is securitization. This is where many homeowners become confused. Thousands of loans may be pooled together. Those pools are placed into trusts. Investors purchase certificates backed by those mortgage payments. Then you have parties such as a sponsor, a depositor, a trustee, a servicer, a master servicer, a custodian, and a document custodian. Stage 4, servicing transfers. The ownership may still stay the same while the servicing changes. Examples: Ocwen to PHH or Onity, or in my case was Bank of America to Greentree to Ditech. Important things when loans change hands with servicers are payment history mistakes, boarding process mistakes, transfer notices mailed to incorrect addresses, RESPA requirements not followed, possible accounting errors in your escrow or the loan itself. Stage 5, a performing loan. The borrower typically makes all the payments, the interest accrues, escrow is collected, taxes and insurance are paid. Once the loan is paid in full, the lender files a satisfaction and the lien is removed. This is the healthy stage of the loan. This is what most people expect. Stage 6 is default. Something changes. Job loss, illness or death, divorce, unexpected expenses such as natural disasters, fire, flood, tornado, hurricanes, servicer abuses. That's a whole different ballpark. Homeowner insurance rate increase. Florida is a good example. Taxes increase. Then you have your adjustable rate mortgages that become due, or a balloon payment due. A loan modification with predatory terms can cause default as well. So as a result of default, this causes missed payments, late fees, default interest, property inspections, forced place insurance, and loss mitigation. Stage 7, this is where collection activities start. The borrower begins receiving collection letters, phone calls, demand letters, notice of default, acceleration notices. They must comply, though, with a number of federal mortgage servicing regulations primarily found in 12 CFR Part 1024, Regulation X, under the Consumer Financial Protection Bureau's rules. Let's talk about these for a minute. Federal mortgage servicing rules. Before a foreclosure is filed, federal law imposes important obligations on mortgage servicers designed to give borrowers information and, in many cases, an opportunity to avoid foreclosure. Early intervention. Servicers generally must make good faith efforts to contact borrowers after delinquency to discuss available loss mitigation options. Telephone outreach, written notice, information about foreclosure alternatives. Continuity of contact. Borrowers who became delinquent should generally have access to personnel who can assist them with their loan and loss mitigation options, meaning you get a single point of contact or a team, ability to obtain loan information, help with modification applications. Then you have your loss mitigation. If a borrower submits a complete loss mitigation application, the servicer must follow federal procedures for reviewing it. So let's discuss loan modifications, repayment plans, forbearances, short sales, deed in lieu of foreclosure. All these things are in the loss mitigation umbrella. The 120-day rule. One of the most important protections, guys. Generally, a servicer may not make the first notice or filing required for foreclosure until the loan is more than 120 days delinquent, subject to certain exceptions. The waiting period is intended to give borrowers time to pursue alternatives before foreclosure begins. Notice requirements. Servicers send various notices during default, which may include late notices, breach of default notices if required by the loan documents or applicable law, acceleration notices, loss mitigation correspondence. Explain that specific notices required can vary depending on the mortgage documents and state law, in addition to applicable federal servicing requirements. Error resolution. Borrowers may dispute servicing errors. Examples include misapplied payments, incorrect balances, improper fees, escrow errors. Servicers are required to investigate certain asserted servicing errors when a proper notice is submitted. Request for information. Borrowers may request information relating to the servicing of their loan. Examples: payment history, owner or assignee information, escrow information, fees and charges, loss mitigation records. And then there's also dual tracking protections. One of the most important concepts is a servicer generally cannot continue moving forward with certain foreclosure actions while simultaneously evaluating a complete loss mitigation application in violation of the applicable federal rules. This practice is commonly referred to as dual tracking. Accurate record keeping. Servicers should maintain accurate servicing records, including payment histories, escrow accounting, fees, and default history, communications, and transfer records. In foreclosure litigation, these records often become key evidence. Keep that in mind. Stage 8 is foreclosure referral. Servicer hires a foreclosure law firm. The attorneys review the note, the mortgage, the assignments, the payment history, and affidavits. This is often where document preparation intensifies. And stage 9 is litigation begins. The complaint is filed, the borrower is served, and now the case enters the court. Then we talk about standing, jurisdiction, discovery, motions, evidence, summary judgment, and then trial. Stage 10, possible outcomes. The loan's life cycle can end in several ways. Reinstatement of the loan, loan modification, repayment plan, settlement, dismissal, or even bankruptcy. Also, it could be short sale, deed in lieu, foreclosure sale, appeal, quiet title litigation, or federal lawsuit. Foreclosure is not the only possible ending. Different legal or financial paths may become available depending on the facts and applicable law. So our final thoughts today, guys. Every mortgage tells a story. The documents should reflect that story from beginning to end, And when the records don't match the timeline, that's a signal to investigate further. The goal is not to assume wrongdoing, but to understand the loan's history and to ask informed questions based on the evidence. And again, here's another verse, Proverbs 2:6. For the Lord gives wisdom, out of his mouth come knowledge and understanding. Understanding the life cycle of a mortgage loan equips homeowners to read their documents more carefully, recognize important transitions, and better understand the legal process if foreclosure occurs. Knowledge is key, and trusting in our Lord Jesus Christ to help you fight foreclosure will help you remain in your house longer than if you did not. Okay, guys, I hope this was informative to a lot of y'all. Thank you for watching. Give me a thumbs up if you want, and have a blessed day.